Hello, and welcome to the video, How to Negotiate a Premium Transaction. And if I think about all of the videos that I've put together, this topic, I would say, is sometimes what most people find the most fascinating or interesting aspect of mergers and acquisitions and helping people sell their business. However, most sellers think of negotiating as a zero-sum game where the goal for me is to get more, even if that comes at the expense of the buyer. The reality is that the best transactions and the highest valuations come when there's enough synergies between buyers and sellers so that both parties can get more. Now, I don't mean that in 20 years of doing deals since my first transaction, that there's not a lot of art that goes along with the science of getting a premium valuation. It's just that it means that it's not as mystical as what people think. There's oftentimes a lot of just hard work and strategic thinking that needs to go into how to deserve a premium valuation. So let's talk through that process. First of all, we'll talk about targeting the right buyers. Then we'll talk about a multiple lane negotiating strategy. We'll talk through how to model specific buyer scenarios. And then we'll talk about how do you justify a premium valuation, not from your perspective, but from the buyer's perspective. Okay, as you can see, we're at the maximize and we're now shifting into the optimize phase of our transactional framework that we're looking at of the premium valuation approach. In order to negotiate a premium transaction, as I mentioned before, you need to target the right buyers. You need to have multiple buyers across multiple lanes, and we'll talk about how important that is in just a bit here. You need to have a complete synergy map per qualified buyer that's out there, and then you need to be able to justify a premium valuation from their perspective, not your own. Before we get going, let's talk about what premium really means. Most first-time sellers will focus or over-focus on the economics of a deal, but people that have sold a business will tell you that a lot of other things matter beyond the economics. Strategic fit between yourself and a buyer is absolutely critical, especially if you're going to work with a buyer. You want to make sure that if you're going to spend even 6 months or a year of your life with someone, that you really enjoy the collaborative working relationship with them. And the legal terms and understanding that, while not covered in this video, is there's a tremendous amount of negotiation that happens before the LOI and even more that happens after the LOI before you get your definitive agreement done. And when we're talking about helping you get a premium valuation, we're not just talking about the bubble on economics, which is what most people are thinking about. We're thinking about premium economics with a premium culture fit and premium terms that protect you to keep your money rather than putting it at risk. Okay, if you notice, however, when we switch this, we've now switched it to where the strategic fit is on top, the lanes are up next, and then the economics and business terms are third, because that's the correct way to negotiate a premium valuation. You have to target the right buyers and make sure that they see strategies in alignment. You then take from the strategies in alignment and have a collaborative discussion around what are the lanes that work for you that also work for the buyer. And then you work on a synergy map and outline the ideal economic structure that maximizes the value and mitigates your risk. And finally, use M&A expert legal, tax, and advisory counsel to negotiate a balanced but also seller-friendly as possible deal of terms based on the key priority and risks that you see in your business. Let's talk a little bit about targeting the right buyers. And I call it, how should I think about the process of finding the right buyer? Because what we can't do is tell you who your buyer is. There's just too many variables, and that's what an advisory relationship literally over weeks and months is meant to do. However, what we can do is create a framework for you to start thinking about how to separate buyers into categories and priorities that make sense for you. The first one is what I call the who should pay the most criteria. You want to make sure that your buyer has met this. That means that they have synergies, and more important than just having synergies, they know that there's synergies. If you can relatively easily explain it to them, that's good. But if you find that you're trying to really sell them on the synergies and they're just not seeing it, then they might not be your ideal buyer. The second thing is they have to be at least 10 times your size or more in order to have the lowest risk. And the fact of the matter is if you want $5 million for your company and the buyer only has $8 million to spend, they're going to be spending more than 50% of their money on your deal. That's going to drive up their perception of risk, which is going to drive down their valuation, which means that you're probably going to have wasted time focusing on them. And then you want to work with buyers that have the highest post-acquisition lift model that both you and them are signed up to. Next up is, do they have what I call a competency match? What I mean by that is not just are they good people or are they good at Amazon or are they good at e-commerce, but is their expertise specific to what your execution needs are? And I think of this just like hiring. The further away the previous success of a buyer or an employee is from what you're asking them to do, the more the risk goes up. The next one is, are they willing to do the type of transaction structure that aligns with your priorities? You might have found the right buyer, but you really want to roll equity and grow it for 2 or 3 more years, and they don't offer rolled equity. We need to make sure that your transaction lanes match. And then last, but probably not least, most important, do you know, like, and trust them? You're going to be, in essence, working side by side, hip in hip pocket with someone else for many people the first time ever. If you don't share similar values and culture, such as an entrepreneurial nature, a focus on product innovation, or whatever it is that is your secret sauce, you're going to find that your risk of legal exposure goes up by not liking each other. And even more importantly, your risk of just not enjoying the process is going to go way up compared to if you are aligned. Next up is employing what we call and have coined a multi-lane, multi-buyer negotiating strategy. The typical process says just collect up a bunch of offers and then you have 3 or 4 to compare to, and that's the way to get to the highest valuation. The reality is that what you want to do is not only have multiple buyers, but have multiple buyers by lane. Here's the key point in that. If I have 2 buyers that are cash only, and then I have 2 buyers that are rolled equity, and I have 2 buyers that are cash plus contingent, I get to kind of see a much wider range of options than if I just have 3 aggregators, for example, looking to buy my business that have all put forth the same structure. Then what you do is after you've started to work the deal, you start to narrow the buyers and lanes based on your premium valuation checklist. As you learn more about buyers and their options, you start to see the trade-off between the economics of a cash-only deal and a rolled equity deal, for example, and you'll start to self-select which ones seem to make the most sense. And then finally, you're going to select the final criteria of buyers and then look to negotiate lane preferences or in some cases, lane deviations. Once you're down to the final 3, 4, or 5 buyers that are willing to offer you a deal, then you can start shaping the transactional lane that is your preference. If you can see in this example here, we have 2 offers. One is a majority equity deal that's a private equity company, and the offer is to sell right now. The second one is a majority equity by an aggregator, but they're indicating that they want to sell later. Here's the key point in this analysis is that sometimes you'll be comparing offers with different time frames to them, or you may even want to run an internal analysis of should I stay or should I sell? And the point in that would be is to be able to run the model and say, if I hold on to this business for a year, does it get better for me or not? So you might be asking yourself, wow, this sounds like a decent amount of work, Scott. Why does this process work so well and why do you recommend it so highly? And the answer is this. By starting with multiple buyers in growth equity, private equity, cash plus contingent, and cash, and or just taking a loan out, you start to have a strategic conversation with buyers, not just a I want out. Now, if you truly do just want I want out, don't worry, you can eventually move through this process as quickly as you want. But I always want people to start with their eyes wide open and then laser in once they get more knowledge. The second thing that is when you're having this strategic conversation with buyers, you're going to start to communicate to them that you're interested in de-risking, which de-risking always equals to increasing value because a buyer that feels less risk is going to be able to afford more than one that doesn't. It gives you a lot more negotiating options. It's very common if a buyer knows that you're considering 3 different aggregators, they already know what the other offer structures are going to look like. So they don't feel compelled to increase their offer because they may already feel that they're at or close to top of the market. But by having multiple lanes out there, you can say to them things such as, I'd really like to consider an earnout with you, but I have a private equity option on the table that's giving me rolled equity. So I'd really like to do an individual synthetic equity with you so that I could have economics, even though I might not have an equity stake directly in the company. I want my earnout to mirror rolled equity. And if you can do that, you'll then win the business. If you don't have those multiple offers out there, you can't credibly represent that to a buyer. And you might be asking, but wait a minute, Scott, why do I go through all that work if I don't want to stay on board and I just want to sell and get out? And the questions I would ask back to you are this: is the business more likely to perform with you and them or just them? And if you have economics at stake, why wouldn't you consider staying on a few hours a week to make sure that the ship runs smoothly? Also, negotiate your time commitment last, not first, because you want to make sure that you understand what you're signing up for, but you only want to do it once you have the economics in place. And then lastly, know that if you work with expert advisors such as ourselves, we will have legal protections in place to protect you even if your post-transition plan isn't working out. Here's an example about how multi-lane negotiations generated $2.5 million in 6 weeks. I use this example because it really helps illustrate the point. A buyer approached a seller and gave them a $2.4 million offer as what they said was their top offer, and it was based on $600,000 of earnings or a 4x multiple. And the buyer and seller knew each other and they were in a similar niche. The seller came to Northbound and said, "Hey, can you help me?" We put together a packet and we provided a full packet to the buyer of marketing materials. This got the buyer to realize that rather than talking to the seller and thinking they're the only game in town, this thing was about to go on the market. So what do you think that did in the buyer's mind? It started to put their ears up and their radar got out that they didn't want to lose this business. The second thing that we did when we got into the negotiations with them was we said, "Hey, we understand your offer. You might feel that it's a very fair offer. The challenge that we've got is that our owner is also considering an offer of thinking of staying on for a couple of years to continue to grow the business. And in the context of a private equity deal where they stayed on, we believe that the real multiple would generate them about $8 to $10 million over 3 to 5 years, which is double, more than double your offer. But of course, that comes with a longer commitment." So what that allowed us to do then is to negotiate for the exact same business within 6 weeks, $5 million for the business with a similar amount cash at closing. Let me repeat that. We didn't give up money cash at closing, but we added on a 3-year time period, non-contingent, so it wasn't an earnout, just time-based to allow the business to fund the price. And we led that deal process and closed the deal within 6 weeks after talking with the seller. All of that happened because of 2 key things, taking out maybe our capability to negotiate. We had a package that allowed the buyer to think that they weren't the only offer in town. And we had multiple lanes that we were able to credibly discuss with them so that they said, "Wow, you're right. I get it. They might get 3 or 4 or 5 million more dollars if they stay on for a couple of years. I better increase my offer so that I don't lose the bid." The best part about it is at the end of all of that process, even though they were getting paid over 3 years, the seller who really did want to leave was able to exit after 6 months. Okay. Now that we've gone through the process on that side of things, we need to talk about getting a premium valuation and having a synergy map with a quality buyer. I call this the "you're already too good" problem. If you have everything optimized and there's nothing that can provide synergy that a buyer can bring, it's actually harder for you to get a premium multiple, because if you're already ranked in the top of all of your markets and there's no new products to release, the only place to go is down because you're already at the top of the mountain. So what we want to do instead is we want to list out the sell side synergies on the revenue side, such as more variations, new marketplaces, etc. We want to list out the expense savings in terms of shipping costs or lower overhead because they've got more scale. We want to list what might happen in the buyer side business, which could be things where your expertise is helping their business. And once we've done that, we want to be able to create a buyer specific scenario modeled valuation. And what we do is we go through our base, our worst, and our best case, just like we did before, but we layer in the various synergies that we have, such as more capital, new geographies, omni-channel, and 20 other synergies that are out there. And then we redo base, worst, and best case so that the buyer can start to see of what we are together, not just what you are today. I want to repeat that so you understand that. A premium valuation is dependent on the buyer seeing what you are together, not what you are today. And the core question that you want to ask is then, how does this buyer help improve all of the potential scenarios of this business? Because if they do, I'm going to be much more confident to take a premium valuation deal. The last step then is, once we know that there's a premium valuation to be had, is we have to justify it from the buyer's lens. And it causes you to have to actually think 180 degrees different. You actually have to think about the question, how can I make the acquisition cheap for the buyer? Which you might go, well, wait a minute, I don't want to make it cheap for the buyer. But the answer is that you do. And by doing it this way, you'll be the best likelihood to not only get a premium valuation, but actually get a deal closed. So as you can see here with our historical growth rate, if I'm asking for an 8x multiple, which I use that to set it way up there, the buyer's only getting about a 12.5% return on their money if you look along the left, because they have to pay $8 or $8 million for something that's making $1 million. They're only going to earn $1 million a year. It's going to take them 8 years to get their money back, or 12.5% return. But if I can layer in synergies that the buyer believes of future organic growth and sell side synergies and buy side synergies, if they believe that the business is going to double or triple, the effective multiple that they're paying moves in the opposite direction. So in this scenario, it moves from down at an 8 multiple to just north of a 2 multiple, because the earnings of the business justified them paying that higher price. Okay. There's other things that you can do other than generating more valuation and more upside. And as I've talked about a number of times before, the first thing you want to do is demonstrate low risk. You want to also demonstrate the synergy with their existing investment thesis. So it's not only that maybe they're in your category, frankly, maybe they're not in your category, but they need to diversify outside of the category, and you help them achieve that. Or maybe you have suppliers in the United States and they're overweighted in China. So you want to show how your synergy works within their overall investment thesis. You want to be able to demonstrate a positive return from them even after paying you a premium. And you want to demonstrate the seriousness that you're bringing to the process, that if they put a fair deal on the table, there's a high likelihood of closing. And finally, you want to demonstrate that it's easy to take this business over, and that way they know that the risk has gone down, but the simplicity of execution has gone up. This next slide I think is kind of funny because I get asked this question all of the time. And so what I'm going to try and do is summarize 20 years of doing strategic transactions, and yes, I have been at it that long, into 5 key deal points. Let's see how I can do. If you said to me, Scott, tell me what I need to know in order to negotiate a premium valuation for the company in 5 bullet points or less that covers my scenario, even if you don't know my business, here's some of the things that I would point to. Number 1, if you have 1 buyer at the table, you have 0 buyers. You have to keep marketing the company until you have multiple credible buyers at the table at the same time. And the reason that this is true is because if you only have 1 buyer, they're going to realize that you only have 1 buyer because they're smart and they're never going to give you a premium offer. And more importantly, if you only have 1 buyer at the table, you're going to always wonder if there was another buyer out there that would have paid more, and you're going to probably back out. So unless you have 1 buyer, unless you have more than 1 buyer, I think of it as you have 0 buyers. The next one is Solve the buyer's problems, then your own, in that order. Because nobody likes to work with somebody that comes up that just says, I need. Solve their problems, and then you'll build the trust to have them know that they'll solve yours. The third one is, and this is an interesting one because I didn't learn this one on until later on in life, is usually you'll have a first place offer and then you'll have a bunch of other second place offers. Well, your second place offers are a great way to see how high you can set the market. So be willing to look at your second place offer and say, you know what? You're in second place. However, if I could get this multiple with this closing, with these terms and this shorter transition period, then I'd be willing to put you in first. And interestingly enough, a lot of times you'll find that your second place can become your first place buyer. The next one is know when you're selling and know when you're negotiating. And here's what I mean by that. Many people will have a meeting with a buyer, they'll get excited, and the buyer seems to be excited, but the buyer has 3 or 4 questions that aren't answered, and they'll immediately move into, well, what do you think you want to pay me for my business? And can I get this much up front? They're starting to negotiate before the buyer has fully locked in that they want to buy. And the reason why this is going to be disastrous for you is because if you start doing that before they're fully in, you're never going to get the highest offer because they'll still have those lingering concerns out there. In the words of fishing up here in the Midwest, you have to properly set the hook before you reel in the fish. And then the last one is start with the big idea, strategic opportunity, and work backward to the guaranteed payments rather than the other way around. This will help you engage to where your buyer will feel like they're on the same side as the table with you. And I'm not saying that you should take, again, a risky offer, but it's much easier for you to start the conversation around a strategic nature and then back into the details than the other way around. Okay, so you've now learned in depth how to negotiate a premium valuation. Here's the key. Now that you know the tools, the key is not to use them all at once, because every deal point that you ask for uses up what I call a chip. So if you ask for a shorter transition, let's say, that you say, I'd really like to be done in 6 months. Well, the buyer can then use that against you and say, well, we'd be willing to offer you more, but we know that you don't want to stay on for longer than 6 months. So don't ask for deal points. Instead, ask questions, because every question that you ask a buyer where they answer the same as you gives you a free chip that you can use later. And I'll use that exact same scenario, and we did this on an 8-figure deal. The sellers wanted to make sure that they only had to stay on for 3 to 6 months, and they wanted me to keep bringing that up to the buyer. I said, no, we're not going to do that, but don't worry. I know you're not going to take this offer until we land on that. What ended up happening is the buyer eventually got around and said, well, what do these sellers want to do and how long do they want to stick around? And our answer back to them was, well, of course, we want to make sure that the business succeeds, and we really want to work with you as the buyer for as long as you see value in the business. And we trust that you'll come back to us with the answer as if you feel like we're not. The buyer came back, and in their offer, they said, you know what? While we'd love to have you on board, we actually have somebody that already owns a bigger company in this niche that we want to turn it over to. So we need you for 3 to 6 months to make sure that you can move this business over underneath that platform. Well, we never even had to ask for a shorter transition, which allowed us to negotiate a higher multiple and other favorable terms. So the key point in negotiating a premium valuation, said one more time, is don't lead with deal points that you need to have. Ask questions to hear if a buyer thinks about it the same way. And if they do, you got the deal point without ever giving up a chip. Okay. How to negotiate a premium transaction requires you to find the right buyer with the right synergies and the right analysis to justify a premium valuation. The final step then is to get multiple qualified buyers in multiple lanes so that you can continually negotiate the proper trade-offs between your structure, your guaranteed money, and the lifetime effective value that you're going to receive from the transaction. I hope this video has given you insight into the path that you need to follow if you want to break out of a typical valuation and get a premium valuation for your business. Thank you.